Wow, what a wonderful talk and what a very difficult act to follow. So my name is Evelina, and I'm here to make the case for climate-led investing. When it comes to averting the climate crisis, quite simply, we're running out of time. To get to net zero by 2050, we have to halve emissions, global CO2 emissions, by 2030, and that is just 8 years away. What that means tangibly is transformation of the real economy, how we build things, how we power things, how we move things around globally. And to do that, we need capital, vast amounts of it. And at the moment, not enough is flowing where we need it to. And the reason that's happening is not that climate solutions for these really difficult to decarbonize sectors don't exist. They do exist. The problem is more that traditional capital allocation models mean that capital doesn't find their way to them. And that needs to change. Because in the same way that we need to innovate and transform our real economy, we also need finance to change and innovate. And that next step and that evolution in capital allocation is really what climate-led investing is all about. I'll start off with my why and why climate is so important to me in particular. I come from a mixed background. I was born in Ukraine, where my mother is from, and I spent a good chunk of my life in Kenya, where my father is from. Those are two very different countries, but there's a very close similarity in the development challenges that they faced. Kenya is a place that is urbanizing very, very rapidly, but at the cost of huge social inequality and really severe pressure on the natural resources. And Ukraine, and in particular my hometown, has a different story, where in that case, for example, there's often a competition between a decent wage and a decent future. So my hometown is one where the primary employers were steel plants. And so the same place you went to get a good income and provide for your kids was also the same place that meant you grew up in a place where you had really high rates of respiratory illness, and you couldn't go just to the beach half the summer because of the effluent being spilled out into the sea by the steel plants. In both those cases, you have a situation where to have economic opportunity in the present, you cannibalize the future. And it's always been my sense that there's got to be a better way. Capital, at its best, powers economic opportunity. It boosts innovation. It provides fodder to create new business models, to create new technologies, and make sure there's enough of them around to be able to progress and change. And climate-led investing is really coming back to the heart of that and focusing on deploying capital in a way that provides economic opportunity without mortgaging our future, that creates growth today with longevity in mind, ours as well as that of the climate. So first things first, this chart will be familiar to many of you. It's basically charting global CO2 emissions right now from where they are today to how low we need to get them to get to net zero by 2050. There's one thing that I want to flag to you. One, it's a pretty steep line down. But to get to that path dependency of reducing emissions by half by 2030, we need a lot of change to happen in 8 years. And the outlook is not good. Last week, the State of the Climate report came out, and it's a fantastic piece of analysis. And one of the things it does is track progress against 2030 targets across a variety of industries. Within power, it would look at how quickly are we switching to carbon neutral sources of electricity. Within industry, and we're talking about steel, cement, and other industrial processes, how quickly are we finding ways to move away from fossil fuels like natural gas, which is commonly used for a lot of those processes, to electricity, and green electricity at that. Headline, of all of the 64 indicators it tracks, not a single one is on track. They're either off track, well off track, or headed in the entirely wrong direction. And finance is no exception. And indeed, it might be that because finance is off track, we're not getting the fuel that's required to boost the transformation in all of those other vectors of our real economy. Now, it's a twofold problem when it comes to finance. On the one hand, it's a problem of pure scale. The UN estimates that in order to get to net zero by 2050, we need to boost another 3 to 4 trillion every year, globally, to be able to fund climate solutions that will create the necessary change to a net zero aligned end state. So the chart on the left, you'll see two lines. One is an almost horizontal line, which charts how much public and private capital is going into climate solutions today. The other is an almost vertical purple fan, which tells you how much we actually need to deploy in order to stay on path with that 2030 target. We need to increase that by almost 10 times. And that's necessary because that's the capital that will then fund climate solutions to what are the hardest to decarbonize, but the highest emitting parts of our economy. But size is unfortunately only half of the problem. When it comes to finance flows, not only are we not getting enough of them, they're also not all going to the right place. So the chart on the left basically shows you where does the capital come from. If we're looking on the public side of things, often it's development finance institutions such as the UK's BII. And in private capital, which is where we sit and where we're trying to catalyze transformation, there are a variety of businesses that tackle investment across business model stage, across different types of assets. And where does it go? So the bit on the right tries to proportionally represent where what is called climate finance today flows. The biggest chunk of that, you'll see, is what we call asset-light segments. In practical terms, that's stuff like software that's related to the climate in some way. So climate risk insurance, consumer marketplaces, ESG and sustainability platforms. And we need all of that. And the second largest block that you'll see there essentially relates to parts of what you would call the real economy, but are, from a finance standpoint, very de-risked. What that means is these are things that have been built, tried before, tried many times, and feel safe for investors. So onshore wind for renewables would be a great example. The problem is that small box at the top, and to keep it truly proportional, by the way, I'd have had to make it much, much smaller, but you wouldn't be able to see the print that way. That tiny box, that represents the sectors, climate solutions to the sectors, which drive over 50% of global emissions. But right now, they get a fraction of the capital. And why is that? Again, it's not that climate solutions in those spaces don't exist. For example, ways to help decarbonize energy, ways to produce green steel and green cement, ways to supplement higher renewables penetration by finding ways to create medium and long-term energy duration storage, which is a huge gap, even as we ramp up renewables penetration. It's not that they don't exist. The problem is that they don't fit within conventional asset allocation buckets, some of which are on the chart over to the, well, my right, basically. Because take a step back. If you're trying to decarbonize something like steel or cement, you're going to need to do a few things. One, you probably have an element of new technology, in the sense that if this was something that had been done, there'd be 10 of these things before. But you're also building real things. You're going to have to build a real factory, so there's a real asset component to it. And then if you're trying to do this at scale, and steel is a huge sector, at 7% of global emissions, it's basically a country unto itself, you're going to need a lot of capital. And those are characteristics that unify that solution set for what we're calling the highest emitting but hardest to decarbonize sectors. And that means, essentially, it kind of falls between the stools of asset allocation. It is way too large for venture capital, which tends to fund new things. It's too asset heavy for growth equity, which tend to focus on the bits that we have called asset light here, so more tech-enabled solutions. And also, you'd think, surely infrastructure should be funding this. Actually, because a lot of it is new, they won't. It's considered unbankable, in the sense that typical infrastructure financing would be looking to fund project number 1,000, project number 500, not project number 2 or 5. Now, why does all of this matter? It's quite simple. Even if you fix the quantum problem, the first half of the climate finance challenge, without addressing this allocation issue, we will not get to net zero, because we will not actually have the solutions that will build the real economy that's consistent with the net zero end state. So we have to fix both the size gap, but also the climate impact gap. And that's really what climate-led investing is about addressing. Quite simply, we at Just Climate define climate-led investing as an investment approach that seeks to catalyze timely climate impact at scale, while still delivering risk-adjusted returns. And that second piece is actually quite important, because coming back to the size gap, to be able to address the climate challenge, we need a lot of capital, institutional-grade capital. We're talking about our traditional asset owners, pensions, insurance companies, endowments. This is not something that will be addressed by well-wishing individuals or boutique-style investment. We need the whole market to move in this direction. But this is quite a mouthful, so why don't I break down what it all means by talking a little bit about our mission and what it means in practical terms for our strategy. So first, highest climate impact. What it comes down to is opportunity set. And all investing begins with an opportunity set, i.e., what is the space you want to play in? For us, it's the highest emitting, hardest to decarbonize sectors. We're very research-led in identifying where those are, and I've talked about a few of them with you in terms of decarbonizing steel, decarbonizing cement, decarbonizing long-haul aviation or maritime, maritime shipping. And the second piece is timely. We're obsessed with the time value of carbon in the same way that we are obsessed with time value of money, as any other investor would be, when it comes to making asset allocation decisions. We think that, and we know, as the science tells us, abatement today is better than abatement tomorrow. We're very, very conscious of that 8-year time frame that we have to act. And so we're also really focused not on the moonshots, the things that could maybe pay off in 30 years, although they should get funding, but we're focused on those specific climate solutions which, if they were to get the right scale, providing the right amount of capital, that they could really transform the sectors that they're in a relevant time frame for us to hit that 2030 milestone. And the final piece of it is we're looking to create systems-led change. We're hoping to not be different. We're hoping to not be special. What we're looking to do is create a model that others will copy so that huge flows of capital will start to move in this way. And the good news is, by the way, is that so far, there is proof of concept. We've been able to partner with a variety of asset owners, from pensions, who typically are the hardest to convince to do something new, given that they have fiduciary responsibilities to the ultimate beneficiaries, pensioners, to insurance companies, again, not known for being particularly risky, as well as endowments, family offices, and others. And so there is hope. We have a very, very narrow window in which we can act. And finance, same as the rest of the world, needs to innovate and move forward. Climate-led investing is a way of doing that, creating economic opportunity while thinking about our longevity, that of ourselves, but also that of the planet. Thank you.